Hello, everyone. It is good to be with you. We are going to talk a little bit today about taking stock and focus on income planning and budgeting through the COVID-19 crisis. These are extremely difficult times for all of us, as we have seen the likely end of the bull market for at least the time being. It is clearly a concerning situation, but we don't know how bad it will be, whether it will be something like the 2008 crisis or something that perhaps moves along much more quickly. And while there is no exact path forward, since we've never experienced something like this before, we do know that the economy was extremely sound moving into this crisis. And there is a good chance, although no one would know for sure, that we can make a very credible economic recovery from this crisis in perhaps a shorter time frame. So we'll begin tonight with the notion of taking stock. And before I begin, I'll just quickly mention a number of disclosures. Obviously, there are extreme conditions right now, and given the markets, as we mentioned earlier, opinions can change over time. Also, we only know what we know right now, and then in the presentation itself, we'll focus a little bit on market indices, which, as you likely know, you cannot invest in directly. So what's happening? There are a number of things that we find ourselves in at the present time. Firstly, the virus has been detected in more than 190 nations and grows, by the day. The World Health Organization has characterized it as a pandemic, and at this time, there's no vaccine to protect against COVID-19, and no one knows when we might have one, nor have there been any medications approved yet to treat it. We can track cases of COVID-19 by following the website. Johns Hopkins University website has one. The Center for Disease Control has resources as well. So there's a lot of information that we can get about the virus on the internet, as well as following local news forecasts. There are also some things that we should point to regarding things like unknowns, which create volatility and losses. To begin, it's difficult to predict how this virus will fare. Over the next several months, there are multiple unknowns. Whether the virus itself will react to changes in temperatures, perhaps as the weather gets warmer, whether people who have survived the virus can contract it a second time, and when a vaccine might be developed to protect against the virus. The current market distress is most directly related to the uncertainty around COVID-19 and not underlying weaknesses in the economy. So there is a path forward. And this is the part that I want to focus on in some detail tonight, because we need to remain disciplined and focused in order to maintain a long-term focus on our investments. And secondly, don't forget that we have a financial plan, and that plan will enable you to stay focused for the long term. And thirdly, considering the tried and true planning techniques that make sense when the market is down, we should look at a number of things as well in those areas for you. And these can include things like changes in account structure, perhaps considering Roth conversions, as well as making other provisions as well. The forecast at this time that we're seeing in the market from Wall Street is pretty dismal as it relates to the first quarter of this year, which is over at this point, and the second quarter, which we are moving into. And therefore, we should expect some increased economic weakness. And with that weakness, most likely we'll see increased market concern. Now, keep in mind that any recession would likely to be short-lived, that the January and February numbers were very sound, especially with the banking system. That's a big difference than the 2008-2009 period when we had a financial crisis and banks literally had to be bailed out by the government. And as a result, the data is showing that Q3 and Q4 would likely emerge as positive quarters. Keep in mind that the market, when we talk about the market, the stock market, the bond market is forward-looking. So therefore, as we begin to see a turn, as we begin to see a slowdown, as we begin to see more expansion in the economy, perhaps as things go further towards normalization, it's likely that we'll see a pickup in market activity and therefore prices of securities. Every crisis is different, and it's to be determined exactly how this one will play out. But one thing we do know is that our behavior can impact the results that we receive. We oftentimes talk today in terms of behavioral finance theory, and what it says is that we tend to be driven in terms of investor behavior more often than not by emotions. We also know from those same behavioral finance science that we are not wired as individuals necessarily to do well at investing. And the reason for that is things along the lines of recency bias, which has us focusing more on what's happened most frequently, as well as the notion of positive versus negative sensitivity. We are much more likely to be sensitive to a market decline than we are to be positive about a market gain. This is, again, part of the way we're wired. And so we often talk about the cycle of market emotions and keeping in mind where we are right now in terms of having come off a very strong market. We're in an area that, if it were possible, we might think about investing as opposed to exiting the market. But that's not, again, how we typically are wired emotionally. So we have to keep that in mind and recognize that emotions are not an investment strategy. Along the lines of this notion of buying low and selling high, what's really important to think about is the fact that there are tremendous gains to be made if we can stay fully invested. And if we were to miss a certain amount of market performance because of movements, that could be very, very costly. So for example, if you look back over the time period of 15 years from the end of 2004 all the way through the end of 2019, a $10,000 investment would have more than tripled in value if we stayed fully invested in a market index such as the S&P 500. Now, if during that period we missed just 10 of the best days, just missed the 10 best days in that 15-year period, so for whatever reason, we weren't in the market the entire 15 years, or for some reason we moved our money or made some decisions, we could, having missed those 10 best days, see about half of our investment gain erode or not be achieved. And if we go to 20 of the best days having been missed, we'd be about a third of that performance. And of course, if we go beyond that, much, much worse in terms of the market growth on that $10,000. So it just underscores the idea that we need to remain invested and focused for the long term. Now, when we say that, it's important to understand that when we structure portfolios for investors, we try to ensure the right balance of equities in terms of how they're diversified, and also fixed income, which tends to act as a shock absorber to the portfolio. So the reduction in volatility that we see oftentimes in our portfolio is a result of the combination of equities and fixed income. And so if we have the right portfolio for you, then it's a much better chance, there is a much better chance that you would be able to work your way through a situation when markets decline, as we know they will from time to time, and not panic and potentially, instead of being able to remain invested when markets are low or even be able to invest, we instead would see ourselves potentially selling at that time and missing the rise as markets begin to improve. We, again, don't know what will happen with this particular crisis, but we do know that there have been market rebounds in the past from previous epidemics. This coronavirus is one of a number of viruses, this particular COVID-19. There apparently have been about 7 so far. They include the Middle Eastern MERS virus, as well as the South Asian SARS virus. So it's another in that series of viruses. And of course, we've been through other epidemics, such as the AIDS epidemic, avian flu, going back years ago, others as well, in terms of measles, rubella, Zika virus, etc. The point is that within a period of time, anywhere from 6 to 18 months, we typically see a large difference in outcome and a much more positive market performance. Now, oftentimes there are other factors which could also be in play at the time of the crisis. Again, for this crisis, we tend to be in a relatively good situation economically because our economy was strong moving into the crisis. I want to focus a little bit on the notion of a plan, because especially within our practice, we really focus on this as a major effort to make sure that we work with our clients on a path forward. Without an idea of where you're trying to go, in a sense, it's like taking a trip and any road will get you there because you really don't have an idea of where exactly you're going. But that's not the way we want to live our financial lives. So we tend to focus with you on planning to the best we can. We don't know exactly how things will work out, which is why we often have a plan B and maybe a plan C in terms of how things may work out. But our focus is on a planned path forward for you as clients. Now, that comes along with a number of things, including discussions that we are having with our clients now about the potential need, for example, for liquidity. So a plan should have a number of components in it, which include where we are today, where we're trying to get to, and then how we're going to get there, including how we're going to cover things like needs for cash and liquidity. And in those cases where we need to raise liquidity, we've been speaking to our clients about that and determining ways for us to do that. Trying to think long-term and sticking with a plan may sound like something that's, academically correct, but it may be difficult to do because the current driving fear of the market is the unknown, right? So it's too soon to say what this particular crisis will be like and whether or not it'll be anything like the financial crisis in terms of duration. As I mentioned earlier, we don't at this point think so, given the strength of the economy coming in to the crisis and given the fact that this is a medically driven crisis. It is something that is a slowdown in the economic picture because of this medical condition, as opposed to other types of fundamentals. We know that there have been about 12 bear markets since World War II, with an average decline of about 32.5%. And in the past, those bear markets have lasted on average a little bit more than a year, about 14.5 months. So what we want to try to do is avoid fear-based decisions, focus on the long term, try to not get caught up in the immediate and in thinking about the long term instead, and making, if you will, lemonade out of lemons by potentially looking at things like tax loss harvesting, Roth conversions, gifting, other kinds of things that during a time when market conditions are like this and asset values have dropped are things that we might consider. And of course, very importantly, as I mentioned a moment ago, trusting the financial plan that's in place. And in those cases where there is not a good plan in place, let's move to do that. Later in this presentation, we'll talk a little bit about one of the techniques that we use for that planning. Recognizing that behavior has an impact on performance, we say your behavior can impact your success. So, you know, the caption says, don't leave the movie just because it gets scary. But the real situation here is to just recognize that we have no way of knowing exactly what the outcome will be this time. And oftentimes as we go through a crisis, we think that perhaps this will be different for some reason. But when we look at things historically later, we oftentimes find that it is consistent with other types of outcomes that have occurred in the past. So until then, we don't know. But for now, you know, let's just try to remain calm and move through this with the investment portfolio that's right-sized for the situation. So how do we prepare for COVID-19? A number of things that we know that the experts are telling us are important is to have a household plan of action. I mentioned a moment ago, a focus on liquidity from a financial perspective, recognizing where the income sources are. My recommendation is that you be thinking about a 60-day period when things can be quite disrupted, and making sure that we understand what income sources will continue, if any will be interrupted, what expenses may be limited during this time period, if there's any way to control that, what expenses have to be covered, and how will we cover those, and make sure that we have a plan of attack on the financial side. With regard to our personal matters, things like prescriptions being filled and so forth, so that we have a 30 or perhaps 60-day supply of things, since we don't know what the outcome will be in terms of being able to get pharmaceutical products, for example. We know that that's potentially an issue because a great number of our products today, in terms of the global supply chain, are supplied elsewhere in the world. So in the event that trade becomes difficult, shipments become difficult, there becomes a difficulty in importing things, or production goes out of kilter in other parts of the world, that can affect our ability to have products and services here. So where that's going to go, we don't know, but the expectation is there will be some of those kinds of disruptions. Really importantly is finding ways to communicate. It may be the situation that we may be in a sheltered type of environment for a significant period of time. The experts are saying that one of the ways that this pandemic can be tempered is by having less contact. So what that's going to mean is less ability to be able to get together with others. Perhaps that would include family members as well as friends and other acquaintances. Work will probably shift a great deal from this office environment and work environments to more of a home environment. And if that's the case, being prepared to operate along those lines, whether it's things we need to do to prepare to be able to work from home, things that we want to do to be able to take advantage of other means of communication. So telephone, obviously important, as well as other types of communication, like we're using here, using a video type of technology. So those kinds of things are important, as well as, of course, for those with younger children, considerations around childcare needs, education, and those sorts of matters. So let's think through what it is that's needed, and we will help you along the way with this webinar, along with others in our series that we hope will help you as we move through the crisis together. There are a number of legislative items that we are monitoring. These include things that will likely occur very shortly, including potential government assistance, not only in unemployment compensation, where there's been some change that's been put in place with respect to waiting periods, for example, that are now being waived, the ability to make application online rather than do so in person, as well as other types of economic stimulus that the government is talking about putting in place. So on these matters, we ask you to stay tuned. Again, we'll try with each of our ongoing webinars to have a portion of time to talk about recent developments so that we can keep this information in front of you, available to you on a timely basis. And then to the extent that it affects anything within our portfolios, for example, some recent legislation potentially will allow us to not have to take required minimum distributions. That level of suspension is something we'll make you aware of when that's in place, and then have you make the decision as to whether that's something that you want to take advantage at the present time, as well as the possibilities around having to borrow money, if you will, from yourself through potential withdrawals from retirement assets. So what can we do during the pandemic? Well, as I mentioned a moment ago, one of the things I said at the very beginning of this presentation is the notion of taking stock. What I want you to do as a family, what I want you to do for yourselves as you think about this for your own family unit and others that you care about, is have any of the needs changed? Do we have a budget? As I mentioned a moment ago, I'm thinking in terms of a 60-day, perhaps a 90-day period of time to really have a fix on those things that we need and those things that we don't. Now, obviously, this could be a time when there might be some real bargains, and because retail operations will slow down, so perhaps it's an opportunity to do that. But the flip side of it is we don't want to be spending all of our waking hours shopping online and not necessarily being smart about utilizing assets for things that we perhaps don't need just because we're trying to fill the time. So a nice balance there between those things that would make sense to do, to take advantage of situations where we can buy things more inexpensively, but also not overdoing it. And also, of course, understanding that there are likely to be more disruptions down the line as things like the supply chain begin to be impacted for goods and services. Also keeping in mind that there's this notion of inflation, a very, very difficult thing to exactly put our arms around, except when we think about the price differential of things in the past versus today. Sort of the best way for us to really understand inflation is to have real examples of inflation from the perspective of what did something cost. In the graphic here, we show a sandwich that today might be $5, and perhaps in the future might be the equivalent of $50, just given inflation. Because as we know, if we look back at what we paid for a quart of milk or a gallon of gas at an earlier time in our lives, and we think about what the cost is today, we see a huge differential, again, as a result of inflation. So I mentioned earlier that this idea of budgeting is really important. And in order to help you to do that, we have a number of tools, one of which is Moneyguide Pro. And our Moneyguide software it has a budgeting module. So if you need some help with that, would like a budgeting sheet, some things to consider. Sometimes the issue with budgeting is we don't know exactly where to start. Please let us know. There are a number of areas, for example, you might like a sheet like this, which talks to different types of expenses, and that might remind you about where to look for how things are being charged. In many households today, we're not paying for everything through a single account. We might be putting certain things on credit cards because that's more convenient, or because we're trying to take advantage of being able to get mileage credits, although not really sure when we'll be flying anywhere anytime soon. But again, for purposes of things like cashback and mileage and so forth, we may be using a credit card. And that may be a very smart thing to do because we're paying the balance off every month and we're not being charged any interest. But then it gets confusing. Where is that bill? It's not coming out of the checkbook. It kind of gets lost. So that's something we really want to look at. In my own personal situation, I'm somewhat embarrassed to say that I didn't recognize until much later, towards the end of last year, that one of my utilities was being double billed. I had actually changed the service, gotten a lower cost for the service, and didn't realize that they were charging from two different accounts. And so therefore I was actually paying for the service at the old price and the new price. And so that's something that I've, caught at year end, and I'm working on, getting that credit back. But those are the things that can kind of happen, or that will happen, if we don't pay attention to these things. And so when we have multiple accounts, or we're not looking at exactly what's coming through accounts, those kinds of things can happen. So again, a tool like this might be helpful. I also want to point out another thing that I think is really important. As you may know, one of the things that I did a couple of years ago is go through a period of time of study where I became what's called a certified life coach in a process called life design. So the Designing Your Life program was developed by a number of professors at Stanford University. And the foundation of those principles is that there are a number of areas of our lives that we should probably keep track of, because they're really important to us. And in a way, most everything that we do, most everything we care about, will fall into one of these areas. These 4 areas are love, play, work, and health. And while there may be other ways that you can characterize areas of your life that are really important, I kind of look at these as the big rocks of life, the things that we really need to take care of in order for us to be assured of a happier and more successful life. And when we keep these in balance, we're said to be, potentially happier. But one of the things we know from the life design work that's been done over the years is that the whole notion, and I know it's a very popular notion, of work-life balance, for example, is really a misnomer. It really is not possible to have all of these things in balance at all times. So the graphic is showing here is that if we are fair about this, if we're true to ourselves about this, we may find that at certain times in our lives, things have gotten out of balance. Perhaps work has taken on a bigger part of our lives than being able to give the time and attention we want to our families. And so love comes up short. Or there may be times, especially early in life, when that's the main focus. We just met someone, we want to be with them all the time, and so other things will suffer. And of course, there are the health-related ones. Things like keeping track of our vitals, for example, and our weight and those sorts of things, as well as our mental health. So those all come into play. The areas of our lives, again, love, play, work, and health, are those that I hope that you will perhaps take stock on right now. It's a very good time. I know, for example, it will be challenging when we can't be with family, and that would potentially impact our ability to feel quite balanced and good about where we are in love. But on that front, perhaps we can make a stepped-up effort to be in further communication. Perhaps because we're sheltering in place, there'll be more time for us to take time to do calls and perhaps video types of meetings, if you will, with our friends and family, and perhaps improve the quality of the communication with those individuals that might actually, to some extent, make up for the loss of physical contact. Certainly, in taking stock, one of the things that I'm hoping that we all do is recognize at this time the things that perhaps we've taken for granted. It's a very good time, I believe, because we're going to be forced to have more time with the people that we live with and the people that we love, to really consider how we can balance these various aspects and give attention to the people and the organizations that we really care about. So with that, I'll open it up to any questions that we may have, but I please want you to know how much we care about you and recognize how important you are to us, and that it is our privilege to serve you going forward. So I look forward to more conversations with you. They may take on a different form because we won't be necessarily meeting in person, but in those cases where you have questions, please do call us. In those cases where you have things that are important to you, whether it's things like such as liquidity issues or other types of issues for you or other family members, please let us know. We certainly are anxious to hear from you and certainly want to help. So with that, we'll end the program today. I don't see that we've had any questions that we need to answer at the moment, but if you think of some, certainly be in touch, and we will look forward to seeing you in the near future. As I said, for now, it probably will be seeing you through some type of video medium, but in the future, I look forward to a time when we will be able to get together again. So take care, be well. We'll look forward to seeing you, as I mentioned, in the near future. Take care.